through the conference. John, I mentioned this at the beginning of the conference. How was the conference, and would you recommend to the crowd next year, or just briefly?
It was very interesting, very informative. All the speakers were obviously experts in their field, but they were able to make the material understandable and relatable. I mean, I was saying that they would begin each thing saying who works in this particular field, find out who was doing it, to be able to speak to their strengths and weaknesses. And even if people weren't in that particular field, like we were doing some of the international tax stuff, none of the people there were doing international tax, but they made it applicable. It was really interesting, and it was great to be able to put some of the to see the real world implications of the stuff that we've been studying in class, how it's put into practice by the professionals that were there. So it was, and it's a beautiful facility, and everyone was really cool. So it was a very enjoyable experience. Thank you for the invitation, Doug.
Best part is the free.
Free. That didn't hurt either.
Right price.
We charge $450 for outside, but local students are free. This one, I think this will be the new list accounting. Remember we talked about list accounting, how we convert a operating list of the footnote into balance sheet as a capital list. Now it looks like this accounting rule will pass next week, and then everyone has to use this new list accounting like 2018 and on. So what they are trying to do is a balance sheet. This is a whole U.S. Public corporations, U.S. firms, whole U.S. firms. They might now, if this is passes next week, $2 trillion of long-term lease obligation, long-term debt. Oh boy. $2 trillion altogether. Yeah, they will put $2 trillion of what? Lease asset, right? Lease asset too. But this one will hit their debt equity ratios, and can you imagine 80-90% of this is now in the footnote. The new rule says, no, from now on, you have to take that 80-90% of the operating lease on the footnote into here and show everything here. Well, that will make financial analysts' job much easier because we don't have to convert. Everything's supposed to be on a balance sheet. This is a major, major problem for a capital-intensive industry. They give you here, AT&T, CVS, and Delta, tens of billions of dollars in leases, operating leases. Now they have to put here 20, 30, 40 billion dollars.
And immediately show it as long and short and that, right?
Yeah. Everything has to be.
I mean, sorry.
Everything has to be. In other words, there will be no term like operating leases at all. Now, whether this will be the final accounting rule, I don't know, because economists, all these commentators, they came out this week, last week, saying against this new accounting rule. Too drastic. I don't know what compromise version would pass, if there is compromise version, but this is
all or nothing.
very serious.
Who's promulgating this? The SEC or?
FASB.
FASB.
So is it GAAP?
Oh, GAAP.
It will be GAAP
It
in
will be GAAP,
2018,
yes.
right?
Yes. FASB, right here, there is the SEC, and then SEC will be the investigative arm of GAO. GAO will put pressure on SEC. SEC has a final say on this accounting rules. They can overturn this easily. Look, this is not good for U.S. investors. That's it. Just one sentence. That's what happened to oil and gas accounting. It's been years to pass oil and gas accounting, and SEC says, none of them. Either one of them, not good for US investors. Go back to square one and then try a new accounting rule over again. That's what happened to that accounting. I don't know, this, in terms of magnitude of changes, this is the biggest changes in about last 3-4 decades. In terms of impact on financial statements. So this is what's going on and current case. And if you pick up any magazine, business magazine, CNBC, CNBC, they are talking about this now because of the impact on their business. The other case, deferred tax liability. This is huge. The big issue here, yesterday, International Taxation in session there, also WACA was able to participate together with the Sean. Here, Pfizer piles profit abroad. And as of today, they have a $21 billion deferred tax liability. Are they going to pay off this? See? See? If they bring money in here, profit, into US, they have to pay tax. All they have to say is, we will permanently reinvest this money overseas and make more money for the shareholders. And tax code allow firms to do that here. In this case, I don't know, now $71 billion profit overseas for Pfizer, but out of 71 million, 21 million is deferred tax liability. There is the pending legislation at US Congress, one-time tax on overseas income, only one time. I don't think that will pass under this current Republican Congress. That one-time tax on US corporation overseas profit would be enough to do one major social program in this country. And that will fix this much of the some of the Social Security, some of the Medicaid, the underfunded Medicaid. They say even if that is only one time the taxation on overseas. That's how big. Well, Apple right now, $200 billion. Can you imagine, without adjustment, 35%, $200 billion. And that will go to US Treasury. 21, you don't have deferred tax liability for this year, and several $1 billion will come into the US Treasury. And there are quite a few firms who have billions of deferred tax liability. This too, this is from this week. Two major issues, accounting issues, and both of them look serious. Yeah, at 8 o'clock, most of the 7:40. I got here 7:30. 7:40, 7:45. Most of the doctors, students were here drinking coffee. I have none here. What happened? Doctors can announce that we don't have a class.
Maybe that's why they're going so fast.
How do you think they get here so early?
Yeah, what review?
We are accountants, so we had a long week, all those numbers, those guys not accountants, so we need a review to use.
They have
That's what it is.
they have their excuse. I mean, they are marketers, so. They
I
bring
drank
around.
last night and stuff like that, you know.
We'll take a look at this exam, we have, everyone here. And, agenda for
standards,
the
right?
today, module 8, case, module 9, if there's a time, I just need to read what the module 10. So that is our agenda today.
I read it, but I didn't see any questions. I couldn't process it. I have too many things in my head right now.
problem, you know?
I didn't want you guys to forget about it.
Wait a minute. Oh, you just typed it on that? Good for you.
Okay, that's right.
As you notice, we are moving from here balance sheet. We did the income statement and asset, which is asset here, and then liability. And now we are looking at stockholders' equity here, equity recognition and owner financing. I will say this.
Gonna wait till I get
This stockholders' equity section, as I mentioned prior, has been a dumping ground for FASB. In other words, whenever FASB doesn't have the answer, they say, okay, let's put it in the stockholders' equity section. It used to be the most simple part of the financial reporting because stockholders' equity used to call residual claims. What do I mean by residual claims? Well, creditors will have a claim on asset first, and then whatever is left over will be a stockholders' equity portion, owner's portion. So this used to be called residual claim, and that was the good old days. Now, starting from early 1980, 82, 83, the first one to go here was a AOCI from foreign currency translation. This is the first item in the stockholders' equity section as accumulated other comprehensive income. Why? Multinational corporation, U.S. multinational corporation, was going to abroad to make money starting 60s and 70s. Problem: foreign currency is fluctuating, exchange rate is fluctuating, and at the end of the year, when you convert foreign subsidiary financial statement into consolidated U.S. financial statement, well, translation gain or losses here, gain or losses. Since fluctuation is there all the time, if you put this gain or loss into income statement, EPS will be fluctuating like this. That's why they say, okay, this affects the firm value, but then this will bypass income statement and it will go to a stockholders' equity section, which means, yes, it affects the firm value because equity, firm value, but not current EPS. That was the first exception FASB made. And then later on, AOCI from available for sale portfolio, gain or losses. If there's a gain or losses, then gain or loss from available for sale portfolio will be a other comprehensive income, not current period income. What is the AFS security? Available for sale 9 months and then 90 days, 3 months. In other words, if your intention is to put this security up for sale within 3 months time period, Then gain or loss from unrealized gain or loss from available for financial, available for sale portfolio will be a part of AOCI. They say pension adjustment, stock option adjustment, stock option adjustment. All this affect the firm value, but since it is based upon assumption and stock prices, this will affect your a firm value, but ideally, we don't want to include that into computation of earnings per share because earnings per share will convey wrong information if that goes up and down every time we record this transaction. So that after this, this has been one of the most challenging area of financial reporting because the FASB is still dumping AOCI into here. Their argument is simple. That will bring too much fluctuation into current earnings. Research came out a while ago, quite a few years, 1997. They test income statement, $1 earning, $1 net income, and here other comprehensive income, a balance sheet, stockholders equity section, $1 AOCI. It's the same income. Here, $1 net income is from income statement, current period. $1 income in stockholders equity section. Both affect firm value, but location-wise, this is income statement, this is the balance sheet. He tested whether stock market react differently depending upon the location of disclosure. Are they able to differentiate one income from the other? Or are they same? What is your guess? What is your guess?
Income statement was
More informative? More why?
because that's what people normally look at. You know,
Okay.
How much money did you actually make? And the balance sheet is understood to be your wealth.
Okay. So this is an income, people make a decision based upon this. And this is the overall financial position. So not as much as being sensitive to this. Any other opinion?
I think the income statement, that's gonna be your kind of recurring, your trend of what you're doing, and the AOCI is just sort of, not one-time events, but more out of the firm's control type.
So you
Agree.
agree with
Yeah.
Mario about this one? This one?
And income statement refers to the business of the business. That's what
Okay.
that most.
Okay. Any other opinion?
I think that it's when you put everything in AOCI,
Uh-huh.
it's almost as if you're doing fair value accounting. And I think it's hard to understand for most people. I don't think a typical reader of the income statement is going to look at the AOCI and say, oh, we've got all these things going on, I should really try to incorporate that into their income.
Okay.
It almost doesn't represent financial position like the balance sheet used to.
Because it'll flip the other way later on.
Well, like you mentioned before about the foreign currency translation, it can have an gains or losses on foreign currency can have an effect on the business, but it's not a guide of, it's not an indicator of how the business is actually performing.
The operation.
Okay.
It's not a performance measure, basically.
Okay. The foreign currency transaction, not translation. Foreign currency transaction gain or loss will be current period income statement. Same item.
Okay.
Translation of financial statement into US currency right here transaction is here. So all three opinions, this will be more informative. Any other counter argument? Any other counter argument? In other words, question was this: from stock market point of view, investors, which of these $1 income will have more impact on stock price change? Net income. Oh, I think we have a consensus.
Yeah.
I'll be on minority side. Semi-strong form of EMH. Semi-strong form of EMH. Efficient market hypothesis. It doesn't matter where you disclose earnings information, they will translate that into firm value. Doesn't matter where you disclose. And that particular University of Arizona faculty test the theory of semi-strong form market efficiency. He predicts it doesn't matter where you disclose this item. By the way, about 40% of the transaction volume in New York Stock Exchange is individual investors, about 60% institutional. Average a Joe will not make that decision as much because this one will subscribe a password ID to have access to the content of this item. Financial analysts will analyze this and provide plain language service. So according to efficient market hypothesis, what is a semi-strong form of EMH? Semi-strong. Finance. First session. Dr. Pettit, the best one we have. Semi-strong form of market efficiency. Well, stock price will reflect all the public information and available private information. Strong form of market efficiency, stock price reflect all private and public that went to the floor. Based upon current research results, semi-strong form of EMH is a support. So, yeah, before we go to here, this is the case. In other words, what used to be a very plain part of most straightforward visual clay part of financial reporting now is one of the most complex area of financial reporting, because here one of the major items we need at least a few hours to talk about one of these. Sure.
We're going with the theory, right? In the Pfizer article, it mentioned that we're already, like Pfizer's already put the deferred tax liability on their books.
Mm-hmm.
Okay, so that $21 billion, that's already been accounted for.
On the book. Yes.
On the books.
On the book.
So whether they had to repatriate it or not should technically not make a difference as far as investors are concerned.
Oh, see, as much as you delay, you put on the different tax liability, your cash obligation of tax will not work. You don't pay cash.
Right.
So what is the stock price? Present value of future discounted cash flow. You're not paying cash for this, stock price will not affect it. Once they decide to bring, once U.S. Congress says one time a taxation for all overseas profit, they must bring it from cash outflow, and stock price must reflect future cash
Okay,
outflow.
but here's the other way of looking at that. Cash is not, the cash that they have on hand doesn't reflect their return on equity. right? Because it's non-operating, when we discussed that a couple weeks ago, okay? So the cash they're sitting on isn't benefiting the investors now. If it's overseas, that $21 billion overseas, now that it's repatriated, because it can't be given as a dividend anyway until it's repatriated, okay? So with the efficient market hypothesis, the fact that it eventually must be repatriated because we're going to generate cash flows from it, they've already taken into account the fact that it's also already been taxed.
See, if you bring in $100 million 20 years from now, what is the present value of $100 million 20 years from now as of today?
Right.
Less than 1 million with that kind of discount rate.
Okay.
Actually, if you keep postponing all these taxes, present value of obligation, tax obligation will be almost zero. Almost. And by the way, profit is not 21 billion, $70 billion.
Right.
35% is a $21 billion.
But so if the present value of that 100 million is effectively zero, then again, going by that, the discounted value of those future cash flows is also zero as far as an investor is concerned. Correct?
Yeah, but don't they reinvest and make more money overseas, and that is the overall firm value goes up worldwide? Doesn't matter the location of the cash, but worldwide multinational corporation firm value will go up because they are reinvesting in Eurozone, a firm value will go up there, South America, and we are valuing that.
But it can't benefit me here until
Stock price will go up.
Okay.
Stock price will go up.
I'm just
If they purchase my share back, yeah, stock price goes up, and I will get a increased share price when I sell my own shares to the company. Even if they don't pay dividend. Firm value doesn't limit to this country, worldwide multinational corporation firm value. So if they reinvest, as they say, $71 billion overseas, that will make a 20%, 30% return, and firm value will go up, and stock price will reflect that. Although cash may not be available in this country. And for Apple, that is more than $200 billion the other day. We'll see. I mean, as far as I'm concerned, they don't know where to invest, and they keep piling up their cash. So, here, basic format is a simple, but then AOCI, we need extensive discussion because pension and a stock option, we talk about a stock option as well. It is not an easy discussion because in which case it affects the firm value, and that will be our discussion, most of the discussion toward the end of the session. Two different parts, and we already know, accounting-wise, we already know this is common stocks and APIC and the cash coming in, and on the capital retained earning and AOCI. This is the, and now 2007 and on, non-controlling interest will be on stockholders' equity section. This is a new gap, 2007, well, not new, 8 years old. But before 2007, non-controlling interest was not in this part. Non-controlling interest was right here, NCI, right here. Before 2007. Now, they moved non-controlling interest in stockholders' equity section because this is the change a consistent with IFRS reporting. Under US GAAP before a 2007, they used a mezzanine approach. Neither non-controlling interest is neither debt nor equity, so in between approach, in between debt and equity, non-controlling interest. Now, under IFRS, which subscribe a fair value accounting, non-controlling interest has the same status with controlling interest. Everything must be in stockholders' equity section. So they brought this NCI into right here. That is consistent with entity theory of consolidation. In other words, when you combine non-controlling, controlling together in stockholders' equity section, that is entity theory. Under entity theory, whether you own 80% or 20%, you have the same status. Accounting is exactly the same, except for the differences in ownership. But under parent company theory, which is a in-between approach treatment, parent company is responsible for merger and acquisition, and non-controlling interest, minority interest, is just standby. They are not part of merger and acquisition. Under this parent company theory, controlling interest will take care of goodwill, fair value adjustment. Non-controlling interest is a non-consenting shareholder who refuse to join merger and acquisition. Therefore, they will be treated as a passive investment. Passive investment, they just wait for the dividend. No action. That is why NCI was here, and that is another reason why FASB put the non-controlling interest here, because it is not your equity, but it is not your debt because you don't have to pay it. So what is it? Back then, they say, oh, it is neither. So where we disclose? In between. That's why it's in between. In between approach. Hybrid security. Mezzanine approach. Mezzanine. You know mezzanine, right? When you go upstairs, halfway through, in the middle, that's the mezzanine approach. So this non-controlling interest is not our equity, but we treat them as if it is equity. So you will find out non-controlling interest right here. That's another addition to stockholders' equity beginning 2007. So, well, this is a fairly straightforward presentation of stockholders' equity section, IBM, a common stock, treasury stock. We all know you have three different numbers. Here, by reading your case, you have to use number of shares outstanding, and here, as you see, the authorized number of shares authorized, but this is the bylaw. Each state has their own regulation about how many shares and what par value they must start. If there is a par value in some state, they say you have to use no par value, and authorized and issued. And here, if you subtract treasury stock from issued, that will be share outstanding. So you will see many different number of shares in their presentation of stockholders' equity section. Here you have authorized this many for almost 5 billion shares, issued, and treasury stock. So the most likely outstanding shares in the market will be different between this and this. But if they retire, they can retire stock. You have to add retired stock right here. Retired. So it may not be issued share minus traded stock will be outstanding because if they retired, retired must be added to traded stock to find out common shares outstanding. And this will be used for your EPS computation. Obviously, you have to use weighted average, not the simple outstanding, right? That is the accumulated other comprehensive losses, 2011, 2012. Can you imagine $25 billion? Yeah, how would you like take $25 billion losses to the income statement? This is the beauty of accounting. Yeah. And that is the perfect answer. Look, who has a control over foreign currency exchange rate? Nobody has. Therefore, if we require managers to put this on the income statement, that is not fair for managers because they don't have any control over a currency stock exchange rate. They have a perfect answer for that. Whether that is fair to investors, I don't know.
Well, but the company does have, say you're deciding to do business in Venezuela, okay? That's how you're allocating your resources. And Venezuela has an unstable currency.
Yeah.
So that's a result of a managerial decision.
True.
I mean, it's, separated by a couple degrees, but it is still,
What if you have to import oil from Venezuela? No other choice. What if? We have to do this.
well, I mean, we could spin this on all day because, it's there's a world market price, so there are alternative sources.
But a exchange rate is triggering other exchange rate to change. In other words, if there's exchange rate change between US dollar and euro, that will affect US dollar to a Japanese yen and Venezuela to US, everyone else. So less likely that manager has any discretion or influence over that macroeconomic event. That is a FASB answer. And if you go to stockholders' equity section, they will tell you, change in stockholders' equity section, they will tell you what the content of AOCI here, what the content of AOCI. In other words, how much that $7 billion here, $7 billion, how much is from foreign currency exchange, how much is from stock option and pension adjustment. And that will, they will break down all these items. So I guess we have everyone here.
Oh God.
I can see you're not listening to me.
I'm just staring at the paper.
You're not listening to me carefully. Homework first.
Thank you.
Well, most of you did well. Here, it's time to pay attention to the detail. It's not just enough to say, I understand this at this point. We have to, next, after what? One more session, we will become what? Master. When master, analyze the kind of problem, you're responsible for your professional judgment. Now, go over some computation, casual errors in computation, and like here, it has been total G score has been 2.9, very close to a borderline between a gray and healthy score, but then it goes down. And your interpretation is it headed for major problem in terms of liquidities and chances for a bankruptcy will be even higher if that goes down to 1.8 next year. Some of you did detailed analysis of 3 and 1.81. All of you gave me most of it gave me correct computation. Computation-wise, this is straightforward. We talk about how manager can use this accounting to manipulate their financial reporting. In other words, to increase and decrease their income. Therefore, to get what they want through financing, a bonus, cash bonus, front end loading, because they can purchase material up front and they can recognize whole 5-year period, 3-year period income at first year. And construction in progress can be used to manipulate that. And here total estimated project cost can be underestimated. That will give higher income profit. If this is the estimation, then you can say 280 million. That will give you 140 million at the beginning of the project, at the beginning. So that is another problem. And we discussed this when we talk about a CIP here. Well, everyone, I think. Alternative explanation here. Account receivable quality has been improved. The other alternative will be, this is correct. They might increase income by slashing their account, just like we saw in the other. Here, inventory. FIFO inventory is under inflation, much bigger than LIFO inventory by the difference of LIFO reserve. So when you add LIFO reserve to LIFO inventory, and which is FIFO based inventory, the turnover ratio will go down because your denominator will be higher. So I want to see that, because here, as opposed to here, LIFO, you have last in first out. So older item has a lower price, so inventory turnover ratio will be higher than a FIFO, which is a first in first out. The last thing, most recent purchase item is right here. Here. So here, LIFO basis turnover ratio is over 6, and FIFO basis turnover ratio is this. So implication for profit margin interpretation will be slightly different, because how much you make is a product of turnover and profit margin. So under FIFO, the implication for managers is it may not be fair as opposed to this one, LIFO, because profit margin is there, and then you multiply either this or this, that will be return on asset. So implications for that. A couple of you just mentioned briefly about and number 6, valuation allowances from that company.
Dow.
Yeah, that. How much? What was the income effect? Over 2-year period, effect was to increase income by how much? 3 of you gave me a detailed analysis. 56 million. But just valuation allowance change. and I asked to see whether this is how you just like a Dell corporation, year to year changing valuation assumption change. Only one item is then $56 million increase in income, pre-tax income. I want to see whether you can analyze that and show me that impact. Any questions? The last question I went over, right? Last question. Last question for you is what? Yeah, John Deere, and I will say why. The Walmart and eBay and PSNEG. And many of you got the right answer, and even if you got one switch, because look, inventory, there is no inventory for eBay, there is not much inventory for PSNEG either. So this is a little bit confusing, but then asset will be different, asset structure. So this was the actual CFA exam, Certified Financial Analyst exam, many years ago. Copyright has been expired, so I decided to read that question to see how much you understand. Because CFA exam has a financial statement analysis section. This question is from that part. If you really like this part, this kind of exercise, and comfortable analyzing this, you are cut out for financial analysis. Yeah, make sure I add numbers correct, and let me have that there, so that I can input.
So it's tough. This times this, and I just subtracted
9,204.
Robin, the asset and liability offset, that is before 1996. That's the correct answer before 1996. That is old gap.
Tier 3 versus
109.
9,204.
and then
Introduce
took the
that.
percentage of that. I think I don't.
Asset and liability.
Well, it's been a while for me.
Oh, that's the only
give 'em
point.
back?
Yeah. Oh, that's why.
You got.
If you have any questions, Christine,
No.
break.
It's not saying. Just gotta show me up again. Bread and butter.
Or a little bit.
Yeah, well, for right now, it is easy to say we have a preferred stock and common stock, but it's much more than this. Common stock has a Class A, Class B. Sometimes Class A enjoy a voting privilege, and Class B might not have as much of power a Class A has in common stock. So you will see common stock Class A in terms of voting, participation in income allocation. They have a different class of common stock. Preferred stock also. Preferred stock, there are many different types of preferred stock. Now we'll talk about a different types of preferred stock. Now why it is a preferred stock? Well, this is a preferred stock in this country, but we say preference stock in IFRS. So we'll see slightly different terms. They are getting paid before a common stockholders will get paid. That's why they have dividend preference. When they go out of business, they will get paid first, liquidation preference. That's why we say this is a preferred stock. This is especially true when the preferred stock is a cumulative preferred stock. We'll talk about preferred stock first. Conversion privilege. This is a convertible preferred stock. At holders' option, after certain time periods of the preferred stock issue, holder can convert number of preferred stock into a common share. In other words, common shares is this. Common share has one preferred stock is $100. So if I say 6%, I have 6% a preferred stock, that means I will get $6 fixed dividend by holding this to a 6% preferred stock. 6% preferred stock. So that at certain point, 3 years, contract might say after 3 years, after 5 years, holders option, you can convert this into a 5 common shares. Common shares are $15 per share, $24 per share. Now, at holders option, you can convert this into a common share. This conversion privilege. Conversion. And this is a predetermined conversion ratio, 1 to 5. This will be predetermined in the contract. No ambiguity. And participation feature. We know preferred stock will get income first, but then after you allocating income, the dividend to a preferred stock, there is excess leftover, and you can participate in allocating excess income between common shares and preferred stock. And this is a participation feature, and we all know the participation percentage will be computed, and multiply that percentage to the excess a dollar figure, and then you get how much excess participating income will allocate to preferred stock and remaining to a common share. Convertible preferred stock. This is a convertible. They have Dow Chemical convertible equity in terms of cumulative convertible perpetual preferred stock. Series A were issued 2009. 3 million shares. And in other words, its contract will say how many of this will be converted into a different types of securities. And that is the advantage of this. Common stock doesn't have conversion privilege. But convertible debt, convertible preferred stock, according to contract, you can convert into X number of different securities. That's the advantage. And this convertible option is marketable. There is a market for that option. Option 1. Stock option, Grandville County. This is a good example. In other words, hey, that is what's gonna happen 3 years, 5 years from now. Why there is a value to this option? If you remember stock option accounting, this is a still grant date accounting. Well, that's best we can do, I guess, here. If current stock price is $20 and strike price, exercise price is $20. Current stock price is $20 and you have vesting period of 5 years. Now, it looks like there is no compensation because current stock price is $20. You can exercise your option at the stock price, strike price is $20. So there is no compensation given at the date of grant date. This is the grant date. So you might say, okay, compensation expense is 0. Who's going to exercise by paying fee $20 option when current stock price is $20? You're not making money. Actually, you are losing money because there's a transaction cost, right? So we say at this point, your option is at the money. At the money. Current stock price and exercise price and strike price is the same. If current stock price is higher than this exercise price, your option is in the money. If current stock price is lower than option price, your option is in the water. If you exercise, you are going to lose money. So if this is the case, what is the compensation expense? This is $20 each. This was the accounting before 1996 when stock option accounting became GAAP. Now you have to use what? Here, option model. Black-Scholes, the binomial model or Lattice binomial model, whichever model you choose, you have to find out the value of this option. 1 million option issued, 1 million option at this condition. There is a value to this option itself. Yeah, current compensation is 0, but there is a value to the option. The very fact that you can exercise this 1 million option in the future has a value. Therefore, the very fact that convertible preferred stock can be X number of common shares, that has a value. Because you can exercise that in the future. You can exercise in the future. How we know this stock price will go up so they can make money? Well, we don't know, but there is Black-Scholes option pricing model. Just like Black-Scholes option pricing model will value this. 1 million 2020, no compensation as of today, but the value attached to this 1 million option will be hundreds of thousands of dollars. You plug in 6 different numbers, and this model will generate the value of that 1 million option. Right here. This is a marketable security. It's that. There's a market trading these conversion things. Older convertible preferred stock and then 8.5%. So this, if you have 1 convertible share, you will get $8.50 every year. Liquidation common shares amounting, holder of convertible has a preference liquidation over common shares amounting to $1,000. Each share is convertible preferred convert into 24 common shares, each share, convertible preferred shares. And after 5th annual issue date, common shares exceed $53.72, 20 trading day in a consecutive 30-day window, Dow Chemical has an option to convert AAA into common shares. In other words, hitting target a stock price is not enough. It must be sustained in number of days. In other words, out of 30 a trading day, which is what, 6 weeks, 5 days a week, trading day, Monday to Friday, it must, this stock price must sustain 20 days out of 30 trading days. Stock price at one point can go up and down depending upon one use. But in order to sustain this stock price for over 20 days out of 30, you must have real good economic news. Otherwise, stock price will not sustain at this level for that long. Or, this is a very common way of handling this, or 5 days in a row. Instead of 20 out of 30 days, the DuPont, the data I use, they say, okay, $75 above, your option will be vested. But that stock price must stay there 75 above 5 days in a row. That was their rule. In other words, this option, the vesting option is different from company to company. You can say 10 out of 20 days, 5 days in a row without any window, but you have to satisfy because one-time event can increase that stock price to record high and then they go down again. So you want to see this sustain the stock price before you give out compensation. Now, preferred stock, Procter & Gamble, employee stock option program. That ESOP, this ESOP, in order to have tax advantage, you must satisfy conditions. Condition is this. In order for ESOP to have a tax advantage, this program must be available for all employees. You shouldn't discriminate any class of employees. Otherwise, you don't get tax benefit. And there are few more conditions that you have to satisfy. This is very important condition because compensation expense is this huge amount. I have to make sure that you satisfy a condition before you get any tax benefit. IBM also par value $20 per share. What is the most common par value? What is the most common par value you have? What is par value of your company?
A penny. Is it a penny or $100 of a
Dollars.
penny?
Penny, dollar. It goes to $20, $25. Really?
I've never
really.
No, it's usually like a fraction of a percent.
Very fraction, nominal value. Legal value, par value, nominal value, sometimes $20, sometimes $25. I didn't see anything over $25. Penny, no par value. So authorized this many, and we already saw this one, equal to this. See? Equal to this. Treasury shares. Issue minus treasury shares, and that would be that one. Market capitalizations, and we already know shares outstanding by closing date. Market price per share will give you total market capitalization, and that will be a simple calculation of the value of the firm. And using this, now ranking of market capitalization in this country has been changed a lot. Now, the ExxonMobil used to be number 1. Now, I don't think that will be one of the top 5. They say ExxonMobil is the next Philip Morris. Whoever sells oil will be like selling cigarettes from company point of view. Pollution, damage to your. So we'll see. That's the common stock stated value $1 per share. Now in this case, Procter & Gamble, instead of par value, they have a stated value. $1 per share. And ESOP debt retirement and accumulate other comprehensive income. And we saw the $1 billion Procter & Gamble reserve for like over 1.3 billion ESOP debt retirement. We all know accounting for sale of stock, and this part. Instead of going through debit and credit, we already know. Now we are using cost method. Par value method, we don't use it anymore. Used to be a gap. Both of them are gap. Par value method and cost method. Now the gap. Most of the company is using a cost method, and they are using a cost method here. Sale of stock. Timing, how many shares, as we already know, financing through sale of stock and sale of bond, they say it is half and half. What's half and half? See here, you have balance sheet, asset, now debt market and equity market. Now they are financing half and half here. On the average, U.S. firm finance their operation, asset acquisition, half of them through debt market, half of them through equity market. But what is more expensive?
Debt market.
No, equity market is more expensive.
Equity market is more expensive, right? Sean says that.
I think there's a lot more fees and things you have to pay with the equity market. You have to pay someone
That
that.
is minor to that, but
Right.
That has a tax benefit.
Tax, the interest expenses.
So less expensive than equity. That's why. But equity, you don't pay interest. So which one? Look,
Well balanced.
which one? Which one is more expensive? That one equity. Look, yeah.
Actually, because you invest in companies, it's for the whole Bronco.
Primary claim.
Yeah, okay, so, in case of liquidation, they will get prior claim over this side, because the asset, cash, proceeds from sale of asset will go to bondholder first, and then equity holder first. Now, as we say, 1984, Pecking
Discount the value of the farm.
MIT faculty, is still the leading research in this area. Nobody disputes this. The order of the financing has been short-term debt, no, retained earning, the money you earn, retained earning, short-term debt, and long-term debt, and a stock. This is the least expensive to most expensive. Stock, you don't pay anything. I mean, you don't have to pay dividend. You don't pay anything. Why stock is most expensive from stockholders' point of view? We have this discussion at the beginning of the session. Oh, double taxation? Yes, that is true. Double taxation is this because corporation pay 34% corporation, and when shareholders got dividend, they also pay average 15% tax. So about 50% tax rate in this country. By the way, in terms of corporation tax, U.S. has a much higher corporate tax rate than any other country. Japan and most other countries, 15%, 34, 35 here. See why they don't want to bring cash back? For individual level, Social Security, Medicare, yeah, European Union, they tend to have sales tax, tend to hire, but corporate tax in this country, this is the reason why. This is the most expensive. See, if you have, see, this one, you have to pay for the money you earn, 30 adjustment, this is statutory income tax rate. When and if they got a dividend, they have to pay this much on the average. That's why it's expensive. That is true also. And what the other major reason why a stock financing is the most expensive form of financing?
You have to discount the value of the firm.
Exactly. That is the reason why. See, this is the core of corporate finance. In other words, if this is the firm, this is the ABC, and they are selling stock at $10 per share. Look, my one share is $10. I need to raise $1 billion by selling 100 million shares at $10. As shareholders, you ask this much, shareholders will bid at what shares? Well, we don't know your inside information. We don't know what kind of investment opportunities that you want to have. There is information asymmetry between outsiders and insiders, and this is also more serious problem for small size firms because not much of information is available. Therefore, they end up discounting $3 per share, $100 million, $300 million out of $1 billion will be discounted. This is the result of information asymmetry. Dear CEO, how would you reduce that? That $3 is too much. You want to reduce that to $1, $1.50, so that you save $100 million, $150 million. What would be your action, most effective action to reduce information asymmetry so that bid ask spread is almost no difference here or smaller difference than this. This is a 30% discount. This is the reason why stock financing is the most important, most expensive according to Myers 1984 Journal of Finance article. We're still using that pecking order, financing pecking order, that order. Your CEO, top management, you're having by reading your case, top managers have a stake, financial stake in corporate performance because they get bonus, based upon. So you want to reduce this a $300 million above to less than $100 million. What is your action? How would you make sure that they are very comfortable about pricing your own? Oh, okay, I pay $10. If you do, by looking at what they're doing, I think $10 makes sense. What action on part of a CEO or at the firm will make sure that there's not much information taken? For example, inside information through MD&A and press conference, prospectors will they be looking? But that's the whole problem. You don't have much credibility and credit period with the credit market. You are trying to build up, and this $1 billion financing will make sure you have funding for new factories. You never paid it. They just don't believe it because you don't have any history of dealing with the capital market.
Audited statements. If you get you release some sort of audit report on your statements.
After reading that case, you still believe in the CPA. Well, auditing financial statement. So through auditing financial statement, what information would you emphasize to make sure this difference is smaller here? See, the fact that we have 8 hours, I It's comfortable. I think we have to rush it. Speak up a little bit. What item would you emphasize to make sure that that difference is small? What if I say, CEO, for the shares for 5% new issue, I will spend my own money to purchase 5% of the new issue.
Put skin in the game. Put skin in the game.
Yeah. In other words, oh, this guy is serious to invest his own money in this. I mean, if I don't have confidence in this project, I don't want to spend most of my financial wealth to invest in this company, even if this is your company. That is according to signaling theory. You are signaling to the market that, look, I am serious enough because I am investing my own money and purchase 5% of it. That's usually what they do. Signaling. You must have credible signal. What if you send a false signal? False. Market will punish you. If you look at the literature, those who are trying to send a false signal were punished by the market. And in many different ways. Stock price is the first one. Job market for the CEO is another one. And if you're interested in, you can read those kind of a line of research. Repurchase treasury shares. You need cash to build up treasury shares, and this will be contra item in a stock. So treasury shares, 42 bad. So this is not gain. You never record gain. It will be increasing. APIC treasury stock. This is not just APIC. APIC hyphen treasury stock. So treasury stock transaction brought $6,000 additional capital, and this is a cost net. Treasury stock section 2012. Here you have, this is an accumulate. They both
Wonder how it's negative. But now
13 million shares extra. This is a million. Okay, 13 billion shares. Because this is a million, so we add, we purchase 13 billion. We purchase this many shares. And treasury stock account, 2003, less so subsequent sales. So you can do this analysis by looking at this year-to-year change. How many shares were repurchased? What was the price of the repurchasing that many of shares? Million shares here, $1 million. So this is million. So $13 billion. They spent $13 billion by purchasing this many shares. And if you divide difference between this and this and this, that's the average repurchase prices. Repurchase is really good news in most of the case. What would be downside of repurchase? Wall Street Journal a while ago had an article on downside of the stock repurchase. Upside is, we all know upside, right? You defend your company from hostile takeover, increase EPS because you reduce denominator of EPS computations, and that sends a signal that the management has a confidence in operation. So it has all these good implications for operation. Now, what is the downside of stock repurchase?
Requires cash. Well, it requires cash.
Oh yeah, you need cash.
Outlay.
You need cash to purchase, and you have to pay the open market current price. And usually, whenever they don't know what to do with cash, this is the first time they do. So it might send a signal that, oh, they just ran out of good investment ideas. Perception. And usually, when they purchase it, supposed to be undervalued, management see this, their stock is undervalued. So they are buying their stock at cheap prices so that they can make a resale when stock price went up. It gives also the impression that, oh, stock price has been cut. And there is a downside of the stock repurchase. And how would you use treasury stock? Depending upon where you are in terms of life cycle of your corporation. Stock repurchased by IBM is quite different from stock repurchased by a young firm in Silicon Valley. Totally different implications. We can't say stock repurchase is good for every company, bad for every company. You have to look at the situation they are in, industry they are in, and life cycle. That will give you a good idea of why they are repurchasing their stock back. Now, stock repurchase, this one, as opposed to stock repurchase, this stock option. Well, stock option, you know as much as I like my job. Only problem with my job, we don't have stock option. University doesn't give us stock option. Not for profit. You have to give up that economic side when you sign up your career or your whole entire career for with a not-for-profit like the university. Unless you like psychic income more than economic income. My family doesn't believe in psychic income. I do. Here, according to stock options, stock option has a problem, advantage and disadvantage. And stock option, see, if you give out stock option, manager has an incentive to get more stock option because stock option takes a firm to more risky positions. In other words, a Black-Scholes stock options model, if you take on more risky, then stock option value will go up. Well, this is good because management compensation, a reward will go up at the expense of shareholders because management is not using their money. Management is using corporate funds to advance their personal wealth. So stock option takes firm to more risky position because valuation model will give higher price for stock option if they take more risky position. Higher risk, higher return. And that's exactly what's going on with the stock option. And that has been the problem. And there is option hangover. You can see the option hangover. Those who drink once in a while, hopefully not every. Those who drink. Early in the morning after having drink. We have hangover, right? I did that while I was in college. That's it. I experimented that idea of hangover, option hangover. See, look here. Current stock price is $80. $80 per share. Strike price is, this was a while ago. Strike price was $20 per share. And you have 100 million options. This is a very reasonable case, reasonable example. It might be several hundred million options stock price for high tech, Silicon Valley. This difference is much more than this. For many of the funds. Now, if this is the case, it's not still vested, but assuming this is vested year or 2 years down the road, multiply $60 here, $60 per option, and that will be $600 million of option hangover. Why that is the option hangover?
6 billion.
Who has to pay that $600 million? Shareholders. So this one will not be in balance sheet. This one
$6 billion.
simply
Yeah, $6
a
billion.
footnote item. This one is footnote item. But when they exercise this, assuming this price continue, when they exercise this will be paid out of shareholders' funds. Shareholder must pay this, but they don't recognize the expense. It's hanging over. Stock option hangover. If you look at Microsoft, Apple, Cisco, Intel, you name it. Go to footnote, find out a current stock price is available every day, and exercise price, and how many options are outstanding. That difference must be paid by shareholders. Yet, income statement does not recognize any penny of it. Expense, no expense at all. This is a reasonable. This is 6 billion or
6 billion.
see, it's easy for the company I mentioned. It's a sliding error.
Just a little bit.
Just a zero.
It's not material.
Just a zero.
See, must come out of current shareholders' fund. And these are two major problems with this. You don't want manager to take your something too risky. But they get more money by doing that. That's a major problem. In terms of accounting, well, compensation expense. I think we should do the accounting a little bit and say current stock option accounting is grant date account. Grant date account. Current stock option account is called grant date account. In other words, if you give option, Black-Scholes model, binomial model, you find out that the $100 million is a option value, fair value of the option. And this vesting period is 4 years. You will allocate 25 million dollars. Expense. Compensation expense. Now, because Black-Scholes model says the fair value, current market value of the option is just granted at the date of grant here as a value of it. What are the 6 input values for a Black-Scholes option pricing model? Financial management, correct. Why wrong? Current stock prices, number of options, risk-free rate, stock volatility, dividend, payout ratio, one more, too obvious. I don't remember because it's too obvious. 6th value. 6th value will go into Black-Scholes model even if a current compensation, strike price, and a current stock price is equal, which is usually the case at grant date. These two items, current stock price and a strike price, is about the same. So even if current compensation is 0, this a Black-Scholes model will create numbers, which is 6 numbers you input, and then you have to. risk-free rate. Two options, risk-free. Those 6 values, then it will create. So how much compensation for next 4 years will be charged based upon Black-Scholes model at the date of grant date. That's why we say current stock option accounting is grant date accounting. IFRS has a slight different. IFRS change this depending upon stock price change. We don't do it. Compensation for the next 4 years will be determined at here and then allocate this. Since you recognize expense, reduce your income, but you get tax benefit in the future, what do you have? When you pay out cash here, when they exercise, tax benefit will realize there. But since you recognize expense right here, you are creating deferred tax asset, yes, not liability. Isn't it same as warranty expense? You recognize expense first, and then later on, unhappy Harley Davidson customers driving in, you have to service them. That's why this is exactly same as that. Now, this deferred tax asset, $250 million, and you have 35% tax rate. That's why you have deferred tax asset and total wage expense, not $25 million, $250,000 will be recognized 1, 2, 3, 4. 1, 2, 3, 4 because grant the 100,000 on $10 per share, so 1 million, 4 years, 2.25 million each. How many of you have stock option from the company? Come on, I know some of you have. Subaru, is giving you stock option? No? No.
We have an RSU, we get like 100 shares every year.
RSU,
Yeah.
restricted stock unit.
Yes. At my level. Higher levels have more.
Okay, that. See this thing, this one?
Right.
This is a major problem. Complete was restricted stock and RSU, restricted stock unit. You can sell it. Company will transfer 100 shares to you after you satisfy certain conditions.
Yeah, vesting basically.
Vesting.
You gotta give a certain amount, you get like a third every year.
Only the vesting, the time period, that is the only condition.
Yeah.
Performance, some form attached to performance condition.
The amount of what you get is, like, if staff account like me gets 100, senior gets 150. So as you progress, you get better, you get higher promotion. You know, you're a director, you're getting like 10,000 of these things. You know?
That's the advantage of RSU. They can take company to risky positions because now unlike stock option, RSU at vesting, company will transfer number of shares they promised to you. That's it. That's the advantage of RSU. Yes. Accounting wise, it's slightly different, but yeah, we have this. See, Black-Scholes model, they say produce very conservative numbers. That's why now they are encouraging to encouraging to use a binomial model. Either way, they don't mandate any specific method, but model. Either model will be just fine for measurement purpose. RSU and PSU performance. Yeah.
Retention. Trying to get you.
The stock option, the footnote will be comprehensive. How much is option exercise? 86. Balance out of 90, 86. Option cancelled. Why cancelled? Option cancelled, expired. What do I mean by option cancelled? Option cancelled. in which case option could be 10.
We're giving it to Clay now.